Hey everyone, the economy continues to show signs of some weakening, not falling off a cliff, but one really straightforward way of looking at this and kind of looking through the data is by looking at the bond market, particularly the two-year note, two-year yields, and this is very important if you are a stock investor or a trader as well. So let's go through it. What you're looking at here is a longer-term chart of bond yields of the two-year Treasury note. And if you look at this closely, you can see that there is a repeatable pattern that occurs in bond yields. They typically consolidate, like they did, for example, in 2018, 2019, and then yields collapse. It starts slowly, and then it happens very quickly. Then bond yields stabilize for a couple of years, and then do nothing basically, and then just explode to the upside. And now we've been up here consolidating, kind of boring, if you will. And it's possible, if not quite likely, that the next move could be meaningfully lower in bond yields. Now you might ask yourself, A, how soon, what's the timing? And B, what does that matter to my stock trading and investing? Well, the timing is typically, when you look at something like this, the starting point can be days away, can be weeks or months. The point is to watch it, but right now we're at a critical point where if you were to zoom in this a bit closer, you would see that we are getting closer and closer to potentially breaching this area of support and then ultimately faltering lower. So that's the timing part. The second part of why this is important to people that might just be involved in the stock market and not the bond market is because when you have lower yields, if you were to see a situation like what we had in 2020, that's typically a reflection of the economy softening. So for example, if you look at the left-hand corner here, this was a situation where bond yields started going lower way ahead of any economic weakness, and then finally we had COVID and it totally fell apart. But the move started happening a year in advance. So it wasn't like it started breaking support literally a year before. So basically that would mean that the economy is slowing if this were to continue to happen, and then the equity market, will have a more difficult time, and volatility will likely increase until yields stabilize, and then the stock market will probably start to rise again. So that's my point of view in that. Hope it makes sense. We'll see you in the next video.